Happy Monday. It is Monday, November 14th. Let's just dive straight in this. We had a great week ending last week with the consumer price index report that came out, and that positively impacted mortgage bonds. So, what does that mean for mortgage interest rates? Well, let's discuss that. So I know the first thing you're going to ask is, where are interest rates? So let's just jump to that screen, but I want you to keep this in the front of your brain. I don't think rates are trending down to stay permanently yet. So let's talk about why I don't think that. So here is the screen that I want to share with you. This is Mortgage News Daily. Again, one of the many platforms that I use to really take a look at where mortgage bonds are going in averages. Keep in mind, when we talk about averages, this isn't my company. This is averages. And this is going to be averages of all conventional loans or average of all FHA loans. So it could be somebody with great credit, low credit. It could be somebody with a lot of reserves, not much reserves, huge down payment, really low down payment. It's going to be the average of all of the loans that got locked and what that average rate is looking at. So if you're coming in with a buyer or yourself personally purchasing a home and you're coming in with a lower credit score, you're coming in with a lower down payment, you're even getting concessions to help with things. Maybe you have a duplex you're buying, one of the many 30 things that affect interest rates. This isn't going to be your rate. Your rate will be higher. This is average. So let's look at what we're doing. So here's a 30-year fixed daily summary. If you looked at November 4th, the interest rate average was about 7.29%. Even at November 9th, 7.22%. Thursday of last week was the great day that we had a huge uptake on where mortgage bonds were going, and it dropped to 6.62. So for today, 6.65%. We've lost a little bit of the ground on mortgage-backed securities on the bond, but not a whole lot. What does this mean for a consumer? Let's assume that your client has a $450,000 mortgage. And that's not their purchase price, that's their mortgage. Just principal and interest. If they looked at November 14th interest rate or November 4th interest rate, the difference between those principal and interest payments would be about $193 a month. So you pair that with a seller paid interest rate reduction, your consumers can really save a ton of money with a move like this on mortgage bonds. Why did mortgage bonds move so much? Well, part of it was the consumer pricing index report. So those are one of those important reports that we look at every month to see how much it's costing an average American to live in their home. What are their utility costs looking like? What are they spending money on groceries? Things like that. And that helps to see where inflation's heading up, down. So it showed that inflation reports came in lower than estimated. So of course that sends everything for tizzy out on the bond markets, because inflation being low is great for mortgages. What does that mean? It means that people are slowing down what they're spending. So that's what the Fed is trying to get us to when they do the Fed fund rates. When they use it like a gas and a brake, when they put the brake on it, they're raising the Fed funds, which is the cost of banks charging overnight costs and things. And when they put those brakes on a little bit, that helps to slow down what everybody is spending, because it's harder to borrow overnight money. It is more expensive our interest rate on credit cards. It's harder for businesses to maintain payroll, and so they go through some unemployment shifts. That slows down the economy, and unfortunately, that's what has to happen to slow down the economy, so less people are spending money to slow down inflation. Key indicators I always look for is what is going on with car dealerships. So you'll notice when the economy is starting to struggle a bit, car dealerships are one of the first ones that you'll see a big shift in. You'll start seeing advertisements for cashbacks, incentives for special financing. You might see an incentive for maybe purchase the vehicle and you don't have payment for 2 or 3 months, or a special interest rate that they're offering for a little bit of time, or $500 holiday cashback to give you a $500 card to use after purchasing. All those kind of sales gimmicks that you look for, those are the things that you really need to watch for to start seeing where the market is shifting. So we started seeing that the last couple months. I started to notice that more and more. And recently just seeing how much each car dealership is really trying to incentivize you to come and purchase from them, that has gone up tenfold. So that's one of the big indicators. Then the second indicator that you start looking for is what's happening in stores. How much are people really purchasing in stores? How busy are stores being? And you start watching the reports of stores to say what's happening, like online sales. Are things slowing down for stores? Are more sales happening? So when you walk through your local Target or Walmart, all of a sudden, are they having sales versus what they weren't having previously? Those are another big indicator. And then, of course, the biggest one to see is unemployment numbers. That's the one that we're not seeing. That's why I'm not sure that mortgage interest rates are going to stay here. I kind of predict interest rates might actually tick up a touch more. I kind of predict they might go quite a bit higher too. And it's only because we're not seeing the unemployment numbers happen. And so I do see that the feds are going to come out with negative comments that this is only one report. We can't rely on this report, which is what they did say on Sunday. But they're going to really come out in negative Nelly mode to slow down that increase. And we are going to start seeing some sell-offs on bonds. So here's my suggestion. I always say, don't buy a house for the interest rates. Don't try and time the market. Purchase a house when financially you feel comfortable in that position and purchase, because over time, no matter when you own a house, there's going to be opportunities to refinance when it makes sense. Or it might be an opportunity to sell that home and move and not even have ever refinanced. But the big thing needs to be the comfort level and what the payment looks like, not to jump on the bandwagon just because interest rates are lower. That's why I really suggest to my agents that I work with, let us work with clients well early in the beginning of the game to help manage their debts, help them to massage their credit score, help them to figure out what their dream payment looks like and what's comfortable and what's not. Because right now that I see this interest rate, which is fantastic, buyers are going to lose some ground right now on purchasing a home. So if you're in a position to purchase a house, absolutely buy. Right now is that opportunity. If you're hoping for a huge discount from the seller to buy down interest rates or not have so much competition, as you see rates come down, you're going to lose that ground very quickly. And there's going to be more competition, which means less discounts. So it's always a pro and a con. So I think buy. If you're ready right now, go find the perfect house. These are lower interest rates. Buy. If you're not financially ready for what that payment looks like today, work with your lender really early, fix the credit, get everything geared up, start working on your budget, slow down on what you're spending. Don't go crazy at the holidays and buy a lot of things, because we are going to see, I really think, rates adjust down a little bit and we're going to see competition flare up. So your opportunity to ask the sellers to help with concessions on your financial behalf is going to really come down with the competition going up. So I think we're in a healthy spot at the moment. I think this is a very exciting news. I don't know how long it's going to last. I hate to be a negative Nelly on the positivity that we're seeing at this moment. I think it's going to really uptick buyers this week. So definitely educate, but we need to really be protective of our buyers and let them know here's today's rate that you qualify for, but here's what that same house is going to be if that rate does jump back up. Because when we see adjustments like this, where we see it positive on the bond, meaning interest rates are down, we see it slower for a recourse on the lender side. So we don't instantly see the lower interest rates the very next day or the day that it happens. We tend to see it if it's stabilized and slower. When it's negative, we see it automatically. We see pricing happen multiple times a day where interest rates change. So I always encourage clients, know what the best rate is today. It's not locked though. So know what the worst case scenario could look like too. So that way you can shop within that picture to know where your comfort level is. Work with your lender really early on so that you know what you can afford to do. And if now is not the time to purchase, work with that lender really early on so that you're educated. You have created a budget. You already have savings put aside. Because as soon as we do see an opportunity where interest rates do come down more, you're going to lose to competition. There's going to be a higher competition out there to buy houses again. And that is really going to take away from your net profitability that you could make off of sellers today that don't have the same opportunities going on for them. So let's just watch how this happens. But share this message, get it out to people so that they know what is happening with rates, so that they do know what's happening with housing markets. And if you're one of those people waiting for the housing market to crash, I really implore you to go and look up Housing Wire and read some of their research. So if you look at some of the markets where we saw a significant increase, like Seattle, San Francisco, things like that, where we saw house prices really go up high and it feels like they came down a lot. Back in 2008, we saw about a 30% of homes were under foreclosure activity. We're just under 2%. So right now there's so much equity in most people's homes that they're not moving. And if they did purchase the house for a big chunk above what the house appraised for, they paid for that out of their own pocket already in cash. So they're not short on that money unless they needed to sell. So if their interest rates were low and for some reason they can't afford to be in that house, but they can't afford to sell it, doesn't make sense, they will rent out that house and their rent will offset their mortgage payment tenfold and allow them some flexibility to move somewhere else more affordable. So housing crisis crash isn't going to happen. Houses are probably just going to get more expensive as time goes on because the inventory is smaller. Look at your vehicles. As vehicles were less and less and less available, their prices went up. Now that there is incentives to buy vehicles, manufacturers are not making the same number of vehicles that they were previously. So there's still an inventory push, even though they're giving you a little bit of a discount or an incentive to purchase. The price is still staying up there. They're still expensive. They're not going to be coming down. Same with housing. It's just not going to be coming down. So really make sure that you watch for key indicators. Reach out to me. I would love to help assist you in building your plan to get there. And if you're one of my agent partners watching this and you want to talk about how we can work on this on maybe one of your listings or help some of your other buyers that are stuck at the moment, just not sure how to proceed, let's connect, reach out to me directly. Let's schedule an appointment and let's talk about how we can utilize the opportunity to help home buyers, because this is a significant savings. And this is still possibly an opportunity to get some seller concessions and less competition. And this is a really great opportunity to secure your financial health for the future so that you're in a good financial position.